what we are witnessing right now, don't go freak out and say, Lance said we're going to have a financial crisis. That's not what I'm saying. What I am saying, though, is that if this gets out of control and if it is not contained, we have that risk of another type of credit-related event.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here back at the end of another week, featuring my good friend, the unsinkable portfolio manager, Lance Roberts. Lance, how you doing?
I don't know about unsinkable. I felt like Spencer in 1923, just struggling to try to get back home.
Well, hey, you're still here. You're still here at the end of a very turbulent, volatile, rollicking, wavy week. So anyways,
Yeah.
I think that constitutes unsinkable in my book.
Well, so far so good.
So far, so good. Look, Lance, I mean, there's no sugarcoating it. It's a crazy time in the markets. I really empathize with your role here of trying to just captain the assets that are in your custody and your stewardship through all that. But I know it's a very emotional time. I'm sure you're getting all sorts of calls from clients. I'm sure just for you and the RIA team, your co-portfolio manager, Mike Leibowitz, it's probably just an emotionally taxing, challenging time. So we're going to dig into all of it, but how are you guys doing?
Well, no, that's actually kind of the surprising part of all this is that, normally when you kind of get to this volatile of environment, we get flooded with phone calls from clients just, panicking because, they don't, a lot of people don't really look at their portfolio, so to speak. They just watch what's happening on the headlines, right? Tariffs and the market's down, 6% in a day. And, and obviously that media, drives people, to make emotionally kind of charged decisions, whatever it is. But, you get fed that media headline and then that translates into, kind of panic. Oh, I saw this on the news and what's going on with the portfolio, right? We haven't really had that much. And I thought we were, right. I thought we would have that a lot more. And I was talking to the advisors, and we have advisor meetings 3 days a week. And, so I'm always, questioning them. It's like, okay, how are things going? How are the clients reacting? And they're like, they're good. The market's down, 10, 11% for the year. Our portfolios are down about 3. So, our goal is always that kind of 20% of the downside risk. We're right in that ballpark right now. From that standpoint, when they look at their portfolios, they're not seeing all this damage that's going on in the markets. And so they're like, oh, okay, it's fine. You got it under control. It's doing all right. So far, so good. We're going to have a lot to talk about. We did a lot of trading this week, because of the volatility and, repositioning portfolios. We did trigger our weekly sell signal. So we can, talk a little bit about that this morning. We've got a brewing crisis that most people aren't aware of in the bond market. And that's so we sharply reduced the duration of our bond portfolio this week because of that crisis. So there's a lot of moving parts this week because of what's going on, because of tariffs and mostly not even the tariffs as much as what's happening in the bond market, which is really a much bigger driver of what's happening in the market right now versus the headline news of tariffs.
Okay. Well, look, let's jump right into all of it. Real quick, folks, before we do, just 2 quick announcements. One, I got to be cryptic about this, folks, but mark your calendars for Wednesday at our usual video release time of 11 a.m. Eastern, 8 a.m. Pacific. We're going to have a guest who I'll just say a lot of folks here will be excited about. Secondly, I'll talk more about this at the end of the video, but I've been appreciative of the folks that have been signing up for our new membership here at YouTube. If you haven't done that yet, just click the join link right below this video. It's right next to the subscribe link. All right, Lance. Let's address everything you mentioned in whatever order you want to do in there. I'm guessing the reduction of your duration trade in bonds is due to this basis trade blowing up that we're hearing so much about. So I'd love for us to sort of clarify for folks what that means, because I think that's something that's a little esoteric for the average investor.
Right. Is that where you want to start? You want to start there?
There or the sell signal, whichever you think is more important.
Well, they're both crucially important. The sell signal is less important than what's happening in the bond market, because this will be solved at some point here, I would suspect sooner than later. So let's talk about that first. So first of all, if you want a really kind of in-depth discussion about what the basis trade is. I did a 15-minute piece. It's on our YouTube channel at The Real Investment Show. It's also posted on Substack as well. So, but I really went into a lot of depth about what this basis trade is and how it's used. But essentially, and to use this is a real base example, just to kind of explain what a basis trade is. So let's use something everybody's familiar with. Let's just use a single ounce of gold, right? So you own a single ounce of gold. Now, right now that looking at the markets, it's trading at $3,200, whatever it is. You go, wow, that's worth $3,200. But you go down to a dealer and you say, great, I want to sell my piece of gold. They're going to give you a different price. And that's because they've got to make money on when they resell it at $3,200, they got to make some money on it, right? There's got to be a profit trade. So you don't get that quote unquote futures price, that what you see in the market. You don't get that futures price in reality. Now, again, don't argue with me over the dynamics. I'm just trying to explain the principle behind a basis trade, which is there's a difference in markets, whether it's a piece of antique or gold or whatever it is. There's often a difference in the markets between what the perceived price is versus what the actual price is. And let's just say that's $100. So just in this case, just using this base example of a piece of gold, let's say the difference is $100. You see it at $3,200 on the futures market. You go to trade it in. The guy says, I'll give you 31. You say, okay, there's a $100 spread. Now, that spread can be taken advantage of. And this is what hedge funds do. And they do this in a manner they will sell short either the Treasury, the US Treasury. So they'll either sell that short or they'll go long the Treasury. And then the futures price, they will either go long or short the opposite direction, and they can capture that spread. So let's just use this example. Let's say they can make $100 on a trade like that. You say, well, that's not much money, Lance, and it's not. They make pennies on these trades. So it's like, well, why is that such a big deal? Well, they take that trade, and so let's use this piece of gold, for example. So instead of me selling 1 ounce of gold as an example, because hedge funds are huge, right? So Citadel, 0.72, these big hedge funds, these are hundreds of billions of dollars in size of hedge funds. So instead of me selling an ounce of gold, let's say that I'm selling 100,000 ounces of gold. So now instead of $100 on that trade, I'm making, $10 million. What's 100,000 times times $100? So, I'm now going to make $1 million on that trade. And then I'm going to leverage that 20 to 50 times, right? So now, we're starting to talk about is billions of dollars at a time in action, and then leveraging that 20 to 50 times. So this basis trade, while very small in nature in terms of each transaction, when you start multiplying the size of the transactions being done and then leveraging those 20 to 50 times, the magnitude of the money they can make on these trades is quite large, and this is why they do it. Now, you go, okay, well, that's the hedge fund's problem, right? Interest rates go up a bit, they lose money. That's the hedge fund's problem. No, it's not. Who loans them the money, right? The leverage has to come from somewhere, and that comes from the banks. So that's JP Morgan, that's Bank of New York, that's Pershing, these other companies that are loaning them the money. So we can do some real simple math here real quick, Adam. If I have a trade out there at 20 times leverage and it moves 5% in a direction, the problem with that is that if I have a 5% loss on this trade at 20 times leverage, 5% times 20 is 100. In other words, I lose 100% of the money on that trade because of the leverage. And that's what's been happening inside the bond market. As this started, we have to go back to last Thursday, Friday. President Trump comes out. He announces these more draconian tariffs than what people were expecting. Market's expecting 10%. He announces, and we talked about all these last week, he announces these trade deficits as tariffs. The market starts selling off. And then on Monday, we have the bond market basically just kind of implode all of a sudden. Interest rates, we were below 4% on Friday. Now, and 4% is exactly where we should have been based on the economic data. And this week, if you take a look at CPI at 2.4%, you look at the collapse in PPI this week, we should be around 3.5% on the US Treasury right now, not 4.5%. But that's because as this basis trade begins to move against them, they've got to mass liquidate these bonds. The banks are calling them up and say, you've got to cover your leverage. They're being forced to sell these bonds en masse. This isn't China. It's not Japan. This is hedge funds being forced to liquidate at this point to a very large degree, which is causing this disruption in the bond market. 4.5% is basically the crisis level. If we get above that, you're going to start really having problems potentially rattle through to the financial system, which is why I expect that we're going to see Jerome Powell step in here probably sooner than later if this keeps going on. Start talking about potentially setting up a bank term funding program, something like that, where the Fed will take the trade off of the hedge funds books and guarantee payment.
Okay, so totally get it. Very well explained. I think you made this understandable to the average person. Just to put a bow on that, because these firms are highly leveraged and are now caught underwater in these trades, they have to sell, right? And so you sell bonds. So what does that do? That pushes the price of bonds down. It pushes the yields up, right? So that's why everybody's concerned, since they're doing this largely off of treasuries. Treasuries are getting sold. Treasury yields are going up. Of course, that's against the interests of the current administration. They're all about trying to get the 10-year as low as they can, right? So nobody wants to see this. The hedge funds don't want to see it. The banks don't want to see it. The administration doesn't want to see it.
Right. And again, so this is really critical. We've talked about margin debt. I wrote that article back in February about margin debt levels at record highs. And the problem with margin debt or leverage in general is that when you're forced to sell, it's you're forced to sell. This is not a matter of choice. If hedge funds had their will, they'd sit around on this trade a bit longer, but they don't have that flexibility. The banks are calling them saying, you've got to cover. And so if I have to cover that at a loss, then they're also having to sell stocks potentially to cover other leverage positions. So it all feeds upon itself. And that's why we're getting these massive moves in the markets in both directions. But we're getting this volatility, these kind of massive moves in markets because this is leverage unwind. Margin debt's getting called in. This basis trade is rolling the bond market, and if it doesn't stop soon, and again, a little bit of history here, real quick, Adam, because most people may not be aware of this, but there was this hedge fund back in 1998. Adam will know this. But there was this little hedge fund back in 1998 that started out as a bunch of PhD economists that were Nobel Prize winners, as a matter of fact.
It wasn't so little, but yeah, go on.
Yeah. So they started this little hedge fund. It was only $100 billion. And they were doing the basis trade. And interest rates went against them. It blew up. The Fed had to bail them out because if they hadn't bailed them out, it would have been essentially a market devastation event across the board because there was so much leverage through this one trade. And that was only 100 billion. We're talking about magnitudes of that size. Let's talk about 2008 as an example as well. It wasn't just bad mortgages that caused the subprime crisis. If it was just subprime loans that went under, that was really no big deal. That was only a couple of $100 billion. There wasn't, the subprime mortgage market as a function of the total bond market was not that large. The problem is that we took those subprime mortgages, we split them apart. We did interest only, principal only. We did all these derivatives against them. We did derivatives upon derivatives on them. In other words, we leveraged that whole subprime market up. And so when it popped, and that leverage fell apart. And there's a great movie called Margin Call. If you've never watched it, and you want to understand really kind of the intricacies of what was happening behind the scenes, Margin Call is a great example of that. But when that blew up, it was that unwinding of that leverage that caused the financial crisis. What we are witnessing right now, don't go freak out and say, Lance said we're going to have a financial crisis. That's not what I'm saying. What I am saying, though, is that if this gets out of control and if it is not contained, we have that risk of another type of credit-related event. Remember, the one thing I've been talking about for the last couple of years is that The only thing that really upends the markets and creates a quote unquote bear market versus a correction is an exogenous, unexpected credit related event. This has the potential to be that type of event. I'm not saying it's here. And I expect the Fed to step in sooner than later. I wouldn't be surprised if we don't hear from Jerome Powell by next week. But if this continues to get out of control, and is not addressed either by the administration, either by the Treasury, or by the Fed, or all three, we're going to have a problem.
So, all right, huge point, huge potential risk.
But Adam, please,
Yeah.
be careful. I want you to be really careful with your headline. I know you don't want to take that piece and make a headline out of it. I'm not saying we're going to have a financial crisis, so don't relay that. I'm just saying that this is the type of event we need to be aware of, because this is the type of event that can cause a big problem for the financial markets if it's not addressed.
I was smiling as you just said it, only because I did, as you were talking, note. I'm going to make this the teaser.
I know you, my friend.
Yeah. And no, I know. So good caveat and big potential risk, right? If certain things happen. Now, Besant, I heard him talk about this 2 days ago.
Yes.
And, I don't want to say he shrugged it off, but he basically said, and I know he's going to, he's not going to say everybody should freak out, but he basically said, hey, what's going on in the 10-year right now is likely to be quite short term because you have these players that used too much leverage and they're rebalancing their books right now. Sort of it might be painful for them. But he didn't give a signal that like, oh my, we're totally looking at this and we're going to have to ring fence this and all this stuff. And again, he probably wouldn't say that because he doesn't want to freak people out. I will say Diamond spoke, I think the same day, and mentioned that he thought that a recession was probably the default case going forward, but he didn't give any nod to like any strong concerns about some sort of contagion risk in the financial market. I don't even know if he even mentioned the basis trade in his discussion. So I guess my question is like, is this really that big of a deal, or is it really something that hey, and I guess here too, if those guys start taking losses, I mean, these are the Citadels of the world. Are these bastards still too big to fail?
Oh no. So yes. So a couple of things. One, yes, the problem is that big. Absolutely, it's that big. And it's not just the hedge funds; it's the banks. And so, of course, Scott Bessent can't say anything. J.P. Morgan can't say anything, because if they did, right, this is like the Fed coming out saying, "Yeah, we've got this. We're having a subprime crisis right now." Immediately, everybody sells, right? And so you just exacerbate the problem, and what might not have been a problem becomes an immediate problem, and now it's unfixable because you've now triggered just mass panic in the market. So they're never going to be able to tell you what's actually happening. We know by looking at what's happening with yields right now that there's a significant problem. And again, you have to understand is that this is a ripple effect problem. It's not just the hedge fund. So, let's just all step back for a moment and say, who cares about Citadel? Who cares about 0.72? If they got themselves in this problem, they deserve to go out of business, right? I agree with that, but it's not just them, because the leverage came from the banks.
But let me ask you this. There's a lot of people watching saying, well, then that's JP Morgan's problem. And if they go away,
absolutely. But again, and then you wrap that out even further, and so what is the Fed's one and really only solely job? It's not
to keep the banking system functioning and then health and happy.
Exactly. It's not full employment. It's not price stability. It's to make sure the banks are functioning. Because when the banks shut down, you have the financial crisis, right? That's the financial crisis wasn't subprime mortgages. That was the match that lit the fuse. It was when banks stopped trading with each other that everything stopped, because credit is the lifeblood of the economy. And so the risk here, and again, we're really careful with this. I'm not saying we're about to have a financial crisis. In 2007, we were saying, hey, subprime is a real problem because of the leverage, but it wasn't a problem then, right? Subprime's contained, it's all fine. And actually through most of 2008, the market was doing okay until we shut down Lehman, and everybody says, I'm not trading with anybody. I don't trust anybody right now. So that's what caused the financial crisis, was when that credit related event impacted the markets across the board. People lost jobs, incomes fell, markets crashed, the wealth effect dissipated, all that. That's the potential we have if rates get much above 4.5%.
Okay,
And
so
this is go ahead.
Let me just ask you about that.
Yeah.
So first off, I get that you're guaranteeing we're having another global financial crisis because of this. So you're being super clear. Congratulations.
Make sure to put that on my title. Lance guarantees.
Exactly. But we had US 10-year Treasury rates up near 5 not that long ago. So why is it suddenly existential at 4.5% when it wasn't at 5?
Well, again, the move it's not the rate, it's the move of the yield, right? It's the speed at which the yield increases.
Okay.
So
going from 3.9 to 4.5 in a super quick period of time. Okay.
Exactly, and it's a big percentage move.
Yeah.
If I'm creeping up, that's okay, because if I'm going from 3.9 to 4 to 4.1, 4.1, 4.2, the hedge funds are trading off of that, right? They're buying here, they're shorting there, they're buying, and it's all fine. But again, what I said before is I've gotten my book set, right? I just made a big leverage bet, and then the market goes 5% against me in a day. Then all of a sudden, at 20 times leverage, not to mention 200 times leverage, which would be a 2% move. I'm sorry, 50% leverage, which would be a 2% move. All of a sudden, I'm losing entire trades. So it's the speed of the movement, not the level, if that makes any sense.
No, totally makes sense. Okay, so other question, and again, I'm not trying to diminish the risk here, but you said, well, so it's different, but it is not dissimilar from what happened to banks when yields started going up, right? And banks found that they had all these quote unquote safe assets on their books, but they were now deeply underwater in them. And the Fed and the Treasury created the Bank Term Funding Program. So you said that you might see the Fed do something similar if the banks start getting, blowback from these loans to these guys.
Yep.
Okay, so they do that. I mean, it seems to work. So, should we really worry that much at this time, or should we only worry if they try something like that and it doesn't stop the bleeding?
It'll stop the bleeding, right? If the Fed and look, I don't know how the Fed will approach it. Again, they've got lots of avenues. They could just, they've already reduced QT to $5 billion a month versus 25. There are cutting rates, but we've got a meeting coming up May the 3rd. So, we could see a 50 basis point. I'm not saying they're going to make a 50 basis point cut. I'm just giving examples. But they could do a 50 basis point rate cut and stop QT altogether as a potential kind of test to see how the bond market responds. But if things are really more dire, right, even more dire than I expect they are right now, you see something like the Bank Term Funding Program, where the Fed comes in and says, whatever your trade is, you give it to me, I'll guarantee you that you make money on it, of whatever it is. So it alleviates the problem of leverage. They're not forced to sell. They can basically sell to the Fed. They can basically put their leverage back in place, and it resolves the bank's potential issues as well. But you can almost be assured that there's a lot of late night phone calls going on right now between the Treasury, the Fed, and White House.
Right.
Which is also why, by the way, that Trump reversed his whole position on tariffs this week. This isn't some master class in negotiation. I've seen so many headlines. This was master negotiation. No, this was a panic move. The reason he put the 90-day suspension on tariffs and moved them back to 10% is because 10% is what the market wanted in the first place. But this was because of what was happening in the bond market. If he didn't pull some pressure off the market, we would have been in bigger trouble sooner.
Bigger trouble sooner, and I can't refute that. All right, so again, I just want to underscore this point. Your level of confidence is quite high that if this starts showing signs of contagion in the banking system, Fed will come in and do whatever it takes. So my point here on this is for people that are maybe getting emotionally riled about this and saying, "Oh my gosh, we could have another great financial crisis." Be very, very cautious taking a big trade on that right now, because the reflexivity of the system to protect itself here. It could very well come and, if Fed makes a big announcement and then we have another day like we had a couple of days ago where the market just goes, unbelievably higher. And we haven't even talked about equities yet, so we'll get there in just a minute. Any other parts about this you want to mention? And you said earlier, hey, it's not China, but I am just curious. We don't really have good visibility into this, but could China be exacerbating this by also dumping some treasuries to send a message to the US at a time when the 10-year is weak because of this?
Well, yeah, but if you think about China, right, they got 700 billion in treasuries. If they start dumping treasuries, it's not good for them, right? Because again, why does China own treasuries? They own it for their reserve currency status, right? And they own it to keep a relative peg to the US dollar. So if they get too far detached from the dollar, it has economic impacts for them at a time that they're already already having to deal with all these tariffs. So I don't want to exacerbate that issue.
Right. They're also trying to weaken their currency, and if they sell the dollar, that actually acts against their interest there.
Exactly. And Japan's the same way. Japan has a national interest in maintaining that peg. So, if they are selling treasuries, it certainly adds to the problem, right? But they're not selling it to such a degree that it's causing this massive move in rates. Again, this is something very systemic to hedge funds themselves. And again, if you X out the hedge fund issue, if we were operating normally, and we were operating normally through last Friday, and yields were coming down to 4%, but actually 3.9. That was a very normal reaction to the reality that these tariffs are going to cause a recession at some point here in the future. Had they been left where they were. Now, potentially with the reprieve, we may forestall an onset of a recession, although the economic data this week certainly doesn't suggest it. CPI and PPI both are really suggesting the economy is slowing down much more drastically than what even economists were expecting, this is what you and I have been talking about.
Right.
Is that when we get to a recession or head towards a recession, that's going to drag inflation down sharply. And we're now seeing that. And so if the hedge fund problem didn't exist right now, rates would probably be below 3.9. We'd probably be closer to 3.8, 3.7, somewhere in there based on this data. But today, interest rates are up again, bond prices are down, even though you just had a massively weak print at PPI. So again, bond market's operating off economic fundamentals right now. And it's a systemic problem to what's happening with this basis trade. And once it gets resolved, then yields will fall back down to where they're supposed to be because we'll get back towards the economics of it.
Okay. So why then are you making changes in your duration change in the duration part of your bond portfolio around this if you think there's a decent chance this could be resolved relatively quickly and then yields will come back down?
Because I don't know how this thing's going to resolve itself yet. And so right now I'm just removing, just like I do with stocks, is when there's unexpected risk to the markets like this basis trade, first thing I do is take risk off the table. And at some point when this gets resolved, there'll be a hell of a buying opportunity for long duration bonds. And so I'll completely reverse that duration and we'll take all the short duration stuff we've been putting in place and then move that way back out to long duration. Because again, once this resolves itself, whether it's at 4.5% or 5% or 5.5%, wherever it gets to, depending on how quick this thing unravels or doesn't, or if the Fed's slow to react, whatever happens. See, that's the problem. It's like I have no idea how this turns out, so I'm just going to step outside of it for the moment, and then when we return back to economic fundamentals, I'll buy bonds because the economics are telling us that yields are going to be a lot lower in the future. Still, that hasn't changed, and it's now exacerbated because of Trump's actions.
Okay. So you're taking and I get this, it's the prudent step. Uncertainty has increased, so I got to reduce my exposure. Mm-hmm. Some could make the argument, well, hey, this is an artificial thing in the short term that's turning these bonds on sale, putting these bonds on sale. Mm-hmm. I want to buy into this, right? You're taking the smart route. So what signals will you look for to say, hey, it's time to get back in the pool here?
The Fed to come in and do something.
Okay, so at a Fed announcement, you'll start buying right away.
Yeah, probably, depending on what it is. I mean, if the Fed says, "Oh, we're not going to do anything, everything's fine," then we're probably going to leave it alone until, again, when you're looking at a bond market that's moving well outside normal movement, And you shouldn't look at a bond and bond prices be down 3 or 4% in a day. That doesn't happen normally, right? That's an event driven move. So until that volatility comes down in the bond market, I'm just going to step outside of it. And I don't mind if I miss the bottom a little bit. It's not going to matter. I'd rather wait with my capital until I'm for sure this risk is past, and this risk will pass. We will get past this, and we'll be back. And just like the stock market, this revaluation of the process, we're going to get past, and we're going to have a great buying opportunity. And so, but for now, we've been raising a lot of cash. We've added a short position to the portfolio. We're just going to sit tight and let this whole dynamic pass us by. And then once we start seeing things bottom and markets improve, like we did in October of 2022, then we'll start adding exposure back to portfolios.
Okay. It's funny, this past week and a half has just, shredded Bollinger Bands, both in equities and stocks, right?
Yeah.
Equities and bonds, right?
Yep.
It's like they don't matter anymore.
Yep.
So let's now trundle over into the equity side of things, and maybe you can pull up the S&P and we can start talking about all the crazy technical carnage that's been done to to the charts.
Yeah, that's a way to put it.
Yeah. I mean, so many different questions, but let's start there. So last time we talked, Lance, stocks had really fallen hard on Thursday and Friday after the announcement of Liberation Day. And then after that, we've had this just bonkers week, which had initially additional downside and then had a massive historic up day. And then we've had weakness since then. So what sense can you make of this technically, if any, at this point in time?
Well, the markets are acting actually pretty normal to what you would expect at this kind of stage of the game right now. But just kind of going back into, let's go back to, Monday before last, where the markets were going to have this announcement from Trump that says, hey, we're going to put reciprocal tariffs on. We got the conversation from last week. Don't need to rehash it. Markets were doing okay, right? I mean, markets had come down about 10%. They're trading sideways and just kind of waiting because the market said, hey, we're going to need a 10% tariff. We'd priced, and the markets had priced in for 10% tariffs. So completely good with that. And had it been truly reciprocal tariffs, this market would have likely recovered and start to move up a bit. However, when the announcement came out, that's where you had this massive sell-off in the markets, as all of a sudden, this is something that's not priced into earnings at all. And it's a very interesting dynamic right now. We'll talk about earnings estimates in a minute here, but this market's had this kind of reflexive bottom. And again, we talked about how oversold the markets were. When you start talking about markets on a standard deviation basis, we were 4 standard deviations below the mean. That's extreme by any measure. And so we did this kind of 61% retracement on a Fibonacci basis, bounced off that support level, rallied back towards the 20-day, failed. And so now we're just kind of struggling here in this kind of downtrend that's forming in the market. So, we're in a corrective market. This isn't a bear market. This is a corrective market. Big difference. Could it become a bear market? Absolutely. But that's not a 20% decline, right? Mm-hmm. So the historical...
Just FYI, it did briefly, right? We were briefly down 20% before we
but again, that's 20% declines is completely arbitrary. Back in the 80s, a 20% decline would break the trend of the market. We're so deviated above long-term means. And again, when we start looking at long-term charts of trend lines and these type of things going back to 2009, you're just correcting a running uptrend in the markets. You're not actually breaking. What's the difference? So real quick, what's the difference between bull market and a bear market? Bull market is a period of rising prices. The trend of prices is rising on a regular basis. That's a bull market. A bear market is an extended period of time, 12 to 18 months normally, where prices are consistently declining. So again, this decline that we're in could certainly morph into a longer period, particularly if we get into a recession. We'll move into a bear market where prices are consistently rallying, then declining to new lows, rally, decline to new lows, and will far exceed 20%. That'll be a 30 or 40% process if we got into that type of what would be technically a bear market. But right now we're just in a correction, right? We
Okay,
haven't
got it.
broken long-term trends, and the long-term price trend is still bullish.
Okay, great. And yeah, just to clarify for folks, you're talking about long-term price trends. I was talking about the technical definition a lot of people use if it's down 20% from the high, right?
Right.
But yours is the
And
more meaningful definition. I can see.
right. And the problem with that definition again is that yeah, you're down 20% from the high, but you could be down 50, if we go back to, basically 1900 and drew a long-term trend line across bottoms, this market could literally be down 40% and never break that bullish trend.
Yeah.
So, the whole point is 20, we've gotten so deviated from long-term means because of what's been going on over the last 10 years that it's going to take much more than a 20% correction to break those long-term bullish trend lines.
Yeah. And I'm just going to mention this, folks, as a little teaser. Just interviewed Jem Carson, the volatility expert. That interview is coming out the day after this one launches. Jem makes a pretty compelling argument that we are now entering an era not dissimilar to what we did at the very end of the 60s through 1982, where it really was a trend change. And I think Jem would probably feel pretty comfortable, Lance, saying, hey, we may actually get to your definition of a bear market over the next couple of years. Yeah.
And that's very possible, right? We've talked about before because of valuations that we can go to a lost decade where markets are, up 20% one year, down 10% the next year, up 5 next year, down 10. And you look back over the course of the decade, you make no money, right? But just lots of volatility.
And what's key about that, sorry to interrupt, what's key about that is say that were to happen and you look back nominally and you were flat, then you have to look at it on a real basis and see, oh my God, I lost a ton of value.
Well, that's the 1960s and 70s, right?
Right,
So
right, it's exactly.
you look over that period, you look 1965 to 1975, markets kind of went nowhere, but on an inflation adjusted basis, you lost 10% over that 20-year period. So yeah, I mean, it definitely has an impact when you have that type. But same thing from 2000 to 2013, right? Markets went nowhere, but on an inflation adjusted basis, you lost about 10%.
Yeah, I'm doing this from memory, but my recollection was Jem's period from like 1968 or 9 to 1982. The real loss was tremendous, like over 50%.
No, it wasn't that much.
Okay, well, I'll leave it to others to debate that. But anyways, you got to look at it on a real basis is the key point.
Yeah, absolutely. But yeah, so it's an interesting, but again, there's no way to tell if we're moving into that period. So, again, it has everything to do with monetary. So again, if you can certainly make that case. If we leave tariffs on in 90 days, we put the tariffs back onto where they were. You don't have any monetary support through, QE, anything like that. You don't have any big spending programs. The future doesn't look great for the markets.
Okay. All right. Well, we'll be tracking it, folks. Don't worry.
Yeah.
So Lance, you mentioned the sell signal, and you're showing, the chart here obviously shows that current prices are, pretty far below now all the moving averages we normally look at.
Right. Well, this is our actual sell signal. So it actually triggered 2 days ago, and the last time it triggered, I have to back this up just a little bit. Say 10.
All right. And once you get this the way you want it to be, you got to explain some of these red and green charts for us.
Yeah, no problem. Let's move this back to September. Yeah, there we go. So this signal, so this is our weekly sell signal, and this is kind of the signal that we use to manage portfolio risk. And the signal does not trigger very often because it's a weekly indicator. It takes time for these indicators to all line up to trigger a sell signal. And so we, when we kind of look at it from that basis, it takes two bottoms, these two kind of middle signals. They can trigger early, and those are kind of big warning signs. And this is why we're saying, hey, we're being a little more cautious with exposures, kind of managing risk. We were taking profits back in January and February because we were starting to trigger a lot of these underlying signals that previously led to this bigger term signal. So again, this is the peak of the market in January of 2022. We triggered that in March. And so that got us to reduce exposure pretty dramatically in portfolios in 22. And then we got they've got the buy signal that came back on in basically kind of March of 23-ish. And so again, we kind of started seeing the bottom form in October of 2022, but the early kind of January, February of 23, we got the buy signal. We just now, so that kept us in the market this whole time. And now we just triggered that sell signal. So with that sell signal this week, we talked about this before, is that when that sell signal would occur, we'd reduce equity exposure from 60% to 45%. So as of yesterday, or actually this morning, we're at 46.5% exposure in portfolios because of that.
Okay. Okay. So what will how will that change your management from here, if at all? You know, having reduced that exposure, and what will you be looking for to add that back on? Will this system here need to send you a strong buy signal, or will there be other indicators?
No. We'll start seeing these kind of two middle indicators. We'll start to see them bottom like we did back around September, October of 2022. Looking at this, you can see that there was kind of this positive divergence in these indicators. They started improving before the market bottom. So we'll start looking at positive divergences in relative strength, positive divergences in momentum, and that'll start to tell us that the market's bottoming. And we'll start seeing reduction in kind of volume selling pressure, et cetera. That's where we'll start adding to equity positions. And then when that strong buy signal kicks back on, that's where we'll overweight portfolios and equities. Will reduce our bond weightings at that point, because at that juncture, we should be in an environment where you'll want to be longer equities and dividends versus more conservative allocations. So we'll start to reverse that allocation structure to be more offensive rather than defensive.
Okay. And, looking at this, and I know it's only one sort of data point, so you got to be real careful, but when you had the strong sell signal back in 21, I mean, that's what? That's a year that you were on that sell signal? Like it was not a brief moment.
No, it's not. It's about, and that's where we're probably going to be here. We'll probably be on this because this is weekly data, right? So it takes time for that weekly data to reverse itself. Now, there are periods where you have shorter reversals and in these sell signals. This chart right here, this is 2022. So the sell signal came in actually kind of in around March. We got that weekly sell signal right here. And then markets continued that correction till we got to that bottom. Again, here's those two positive divergences. But if we look back over a longer term period, so the red line and the black line is the long term and the short term weekly moving average. So there are periods like long-term capital management as an example, where you got the sell signal and then shortly reversed it after back onto a buy signal. So your period of risk off was fairly short. Same thing during when we ended QE1 in May of 2010. Markets began to sell off. We were down about 18%. We triggered the sell signal. Then the Fed steps in, does QE2, and markets take off again, reverses the signal. Same thing when we ended QE2 the second time around, and ended QE2, and then in September we started Operation Twist. Market takes off again. Brexit was another good example. Brexit started to occur back in 2015, 2016. The market's down 20%. You triggered the signal, but then the Eurozone bank stepped in with their version of QE. Markets take off again. So you can see these periods where there are interventions into the markets. Fed taper tantrum, Fed reduces rates, COVID crisis, Fed comes in with 100 billion, 120 billion a month in QE. Those can lead to very short-term signals and reverse. And this is why, you just want to pay attention to them and respond. So yeah, you underweighted portfolios temporarily, but then turn right around and get back in. That's okay. That's just part of navigating the markets. But there are good periods like the .com crisis, like the financial crisis, like 2022, that kept you out of the market for quite some time as the market went through a corrective process. So is this the beginning of a 2022 type market? maybe that's kind of my premise that I've been laying out, is that I think we're kind of moving into this environment where it's kind of the 2022 playbook, where we trigger a sell signal. We have these immense rallies that disappoint. You have these declines. We stay below moving averages during this period of time. Markets continue to decline until they eventually find a bottom. And so we kind of look at this zigzag pattern in the markets that, we're going to have to just kind of navigate through. And then eventually we'll exhaust the selling. We'll start to see some positive divergences in our momentum and relative strength indicators. And that'll tell us to start beginning to put equity risk back to work. But for right now, we're just going to kind of sit on the sidelines a bit and just let this kind of play out. Let this volatility pass us by until we have a better indication, or the Fed steps in, or Trump said. And here's my expectation is that in 90 days, tariffs will no longer be a discussion. It'll basically will be at 10% tariffs. That's what the Wall Street wanted to begin with. And this 90-day pause will just become permanent. We'll just never talk about unpausing them ever again. We'll have these negotiations with countries. We'll come to an agreement. No tariffs here, no tariffs there. And then anything else, it'll just be 10% going forward. And then markets will kind of forget about that and go back to fundamentals.
Okay. I'm hearing, I think you're the third person that I've interviewed in the past week that has basically said, I think it's going to be a lot like 2022.
Mm-hmm.
So notable for folks to identify that pattern. And Lance, if I got it right, you have reduced your equity exposure because of the sell signal, and you have stayed in the bond trade, but you're moving the duration to the shorter end of the curve for now.
Yeah.
Right?
Well, again, just to be clear, I have to stay in the bond trade because we run a 60-40 allocation. We run 60-40, 70-30, 80-20, 100%. We have a dividend equity model that has no bonds in it. So it's got no exposure to the bond market. So yeah, just when we talk about portfolios and you say, well, Lance, you're staying in the bond trade, I have to, because that's the allocation in that portfolio. But now that is primarily all between 1 and 3 years, except for a little smidge in 3 to 7 years. And then I've got about 5% still in the long bond trade, because eventually I'll add aggressively back to that position. So I want to keep a position in there.
Yeah. And just to make sure folks understand, so in the equity sleeve, when you reduce your exposure to equities, presumably you're just putting that in cash, right? The difference in cash. And in the bond portfolio, yes, it's all still technically in bonds, but the further you go towards the short end of the duration curve, the more cash-like it becomes.
That's right.
Yeah.
Yeah.
So effectively, you have similar trends going on in both portfolios.
Yeah, correct. And if you take a look at the portfolio allocation right now, we're currently running 17% cash, because we just added a short position this morning. So, we've got 49% in equities, but part of that is that short position. So, we're closer to 45-ish% in equities and really carrying more like 40% cash or cash alternatives.
Okay. So let's talk about that short position for a second. How are you putting it on? How big of a percent is it? Like, how aggressive is it?
So we did a lot of trading this week. So I got to keep my days straight here because things have moved so quickly this week. Wednesday morning, we're looking at the markets, and the markets were selling off pretty hard Wednesday morning. But tech stocks were holding up very well. We were seeing money flows go into tech stocks. So we reduced our position in AbbVie and Eli Lilly. We cut those in half. And we added about 5% exposure. We bought NVIDIA, Google, Microsoft, Palantir, and Palo Alto Networks. And then, of course, we had no idea that the Fed was going to, or Trump was going to make that announcement in the afternoon. And so the markets took off running. Apple was up 20%, Microsoft was up 20%, whatever. And super big gains. So Thursday morning, as soon as the market opened, we then reduced risk. We then took all that money back off the table and more on Thursday morning. And then this morning, we added a 2.5% position to SPY. It's a short SPY. It's the symbol's SH. So we're just using a simple 1-for-1, not leveraged, short position in the portfolio. We'll build that to 5% Could go as much as 10% depending on what the market does. But if this market, we're kind of expecting the market's oversold here short term after yesterday. We're going into earnings season right now. We just had JP Morgan and the big banks, announce earnings this morning. So we're kind of expecting a little bit of a rally here over the next few days, just a bit of relief rally, if nothing else. And then we'll probably add to that short position just to basically hedge the portfolio a little bit more until we kind of get back to corporate buybacks, which will be end of this month. And then we'll just kind of navigate it from there.
Okay, so that short is really a hedge then. It's not
It's just a hedge.
a tactical trade that you're looking at because I was about to ask if you think there's going to be a short-term rally, why have the
Yeah.
short, but you're having it as a hedge in case things go against your predictions.
Well, this market, I mean, you don't know one morning to the next if you're going to wake up, the market's going to be down 4.5% or up 4.5%. So,
Right.
I kind of expect to lose money on, I'm hoping I'll lose money on the short position because the rest of the portfolio will be performing okay if the markets are going up. So it'll give me a little bit of drag on a beta basis, but I'd rather have the insurance in there that because I can take that off really quick. I mean, it takes 2 seconds to take that back out of the portfolio. So, if the markets start to take off and rally and things start to heal up and this bond market situation calms itself down, that's great. The portfolio, I still have equity exposure, although less of it. Still got bond exposure, although less of it. And if things start to perform, then I'll add back into those trades and participate with that.
Okay, good. That's good clarification, though. I just didn't want folks to take the erroneous perception that you were like leaning into shorts because you thought the sucker's going down. Again, you're doing it more as insurance.
Yes.
High level, because I know for compliance reasons you can't be super detailed, but how is the RIA general portfolio faring so far this year versus the general market, given all the chaos?
Well, so just kind of our benchmark portfolio, which is, and we post this on SimpleVisor. So if you go to SimpleVisor, you can actually see the performance of the portfolio. So it's right there. But as of last night, now this doesn't, because we basically, it'll post up this afternoon for today's performance. I got to wait till the end of the day to update it. But as of last night, the 60/40 allocation was down 3.37%. The S&P was down 10.65.
Okay. All right. So congratulations. Kudos to you and your team.
Yep.
You're doing what your clients would hope you would do.
Yep.
All right. So let's see here. Looking at the time, we're definitely not going to get through most of the things I wanted to.
I'm sorry. There's just so much going on.
No. Don't apologize. This is all great. Let me just reiterate something you mentioned earlier, that we did get some additional data this week on inflation. And basically, the numbers came in cooler than expected. CPI came in for March, annualized at 2.4% versus the expectations of 2.5%. March deficit, PPI came in at 0.4% for the month versus an expected rise of 0.2%. So, a lot of what you and Michael have been predicting in terms of the slowing of economic growth, the cooling of inflation, does seem to be happening, right? We'll keep watching this closely going forward. Interestingly, as you said earlier, you would expect that would be bringing down the 10-year, not seeing the 10-year go up, but we explained all the reasons why that's likely going up in the near term at least. Okay. I just want to give a nod on the day we're talking, Lance, that gold is zooming off to a new all-time high. There's probably lots of reasons about that to discuss. Let's not get into that here, except just to note it. For folks that want a deep discussion about what's going on with gold, you're going to get that itch scratched on Tuesday morning. So Tuesday's interview is going to be with Andy Schechtman, and it's going to be a live stream. So we'll take your live questions as well. So hopefully we answer any and all. Yep, go ahead.
And just real quick, you remember we had a conversation about gold a couple of weeks ago on a technical basis. And I said, hey, look, it's super overbought. You're going to have a correction. And you had a really nice correction. It sold off very sharply, came back down to the bottom of its Bollinger trend line, got to an oversold condition. And then this whole bond market issue cropped up, which was a perfect, that's a perfect catalyst for the gold market. And so you had this really nice correction. It happened almost the day after you and I had that conversation. I think this was either last week or the week before. But had really beautiful correction, gave you a great entry point, and it's been working well ever since.
Okay, great. I didn't realize that because it went down to like just under 3,000. I didn't
Mhm.
realize that that was enough to get it to oversold, but sounds like it
Yeah,
was a nice
on a daily
technical.
basis, right? No, on a daily basis, absolutely. On a monthly basis, no. I mean, it's still grossly overbought, and you're eventually going to have a very long-term, just like the stock market, you're going to have a very long because of that monthly overbought. As probably once we get through all of this tariff and bond market crisis, et cetera, you're going to wind up in a very long consolidation period that'll probably last 3 to 5 years, which is kind of its history anyway. But that'll just work off that big over monthly overbought. But on a technical basis, if you're trading gold, you had a beautiful setup a week or so ago.
Okay. Well, look, so I sent out a tweet on X earlier this morning, basically kind of cautioning gold investors to say, hey, look, enjoy this while it's happening. It's kind of been feeling like Christmas every morning for the
Uh,
past while for us gold owners, which we don't know what to do with because it's been a decade plus of beatings.
yeah.
But I just said, look, just don't get too used to it. Things don't rise forever in a straight line. There probably some pullback coming in the near term. And to be honest, I think a lot of gold owners would say, hey, I'll take a sideways action for a couple years, as long as we don't have to give up too many of the gains that we've had.
Oh no. When I mean sideways, the last couple of times that you had sideways movements, you gave up between 30 and 50% of the gains.
No, okay, well, yeah, you might get some angry
But over
comments from me.
over the period, you wound up even. But during the process, you had a fairly big sell-off on it. And yeah, there's nothing wrong with that. I mean, it's the same thing you expect out of stock markets, right? And it's interesting because again, I know people are going to send you nasty emails about that comment, but
That's okay,
that's
but it's an
exactly what
asset that
happens.
behaves like all assets, yeah.
Yeah, yeah. I mean, but it's all assets. Everybody's been rooting for a big sell-off in the market. Well, here you go.
Yep.
You know, this is what you wanted. So there it is. But the same thing will happen in the gold market. It'll happen in emerging markets. It'll happen in the dollar. It doesn't matter what the asset is. It's just there are dynamic price dynamics that are going to take hold. And when something gets really overbought, it's going to have a mean reversion. If it doesn't mean revert at some point, the system's broken.
Right. Yeah. And again, it is an asset. Stephanie Pomboy made, I think a very important comment the other day. She's been very pro gold for a long time. And she said, hey, don't get me wrong. She's like, I love what's happening with gold right now. And I do think that stocks, have a rough time ahead of them. But she's like, I can't wait for the day where I own zero gold because I'm
Yeah,
so excited to take that money and put it into fantastic companies at deep values, right?
right. And
Yeah,
that will be what happens with gold prices. Eventually, there'll be a
exactly.
shift in that risk sentiment, right?
Right.
So
Personally, I don't think we're quite there yet.
no,
And I do want to note, and I'll get into this in detail with Andy, but we are finally beginning to see the mining complex wake up, right? The mining complex is supposed to be a levered play on the price of gold. It hasn't really behaved like that until recently. The miners have now been outperforming the gold price as well as the gold price has been doing. So I think you're having a fun catch-up moment right now in the mining complex. I think you can make a pretty good argument that there's still a fair amount of that catch up to lie ahead of us, especially as these companies start reporting blockbuster earnings, given how much the price of gold has moved. The thing to take a look at, and again, I'll get in more detail with this with Andy, is silver. Because silver does tend to follow gold. And if you look at the gold silver ratio right now, it's very extreme, meaning silver seems very undervalued relative to gold based on historical metrics. And when silver does catch up to gold, it tends to do so in a hurry. So, you can make an argument, a pretty compelling argument that silver may have a real slingshot moment here. But again, I'll get in more detail with that with Andy. Last thing on gold, folks, just if you haven't read it yet, if you're watching the action in gold and saying, boy, I wish I'd gotten in sooner, but maybe I'll think about buying some now. Feel free to read the free guide to both buying and storing gold and silver that I released a few weeks ago. It's totally free. It just walks you through all the different options, kind of gives you the pros and cons of each. You can get that at thoughtfulmoney.com/gold. All right, so I want to talk about recession risks just because you wrote a piece related to that about the consumer tapping out, and there's been some additional news coming out about that. Almost to the point, Lance, where I'm a little worried that so many people are getting on the recession is coming bandwagon that we could have a repeat of what happened at the beginning of 2023. But before we
that's
get
very
there,
possible. That's very look. I when I was writing that piece, I was like, you know what? This is starting to look a whole lot like 2022 when everybody was expecting a recession. And then, of course, that's always the case, right? Bob Farrell's rule number 9, when all experts agree, something else tends to happen.
Exactly.
And look, I mean, if the Fed steps in here, bails out the bond market, we're not going to have a recession. If Trump gives up on these tariffs, we're probably not going to have a recession. The big recession risk is these tariffs.
Okay, so let me just punt on that for a few minutes
Sure.
because we're recording this, the 10th of April, 11th of April. So a tax deadline is coming up wicked fast, right? Are there any tax deadline steps that are worth talking about right now? I mean, obviously the big one is if you're going to make a contribution to your retirement accounts for 2024 and you haven't done so yet, I mean, you pretty much got to do that like on Monday.
Right.
Anything else?
Yeah, pay your taxes.
Well, okay, don't go to jail, pay your taxes, yeah.
No, everything that you need to do for tax purposes, financially wise, portfolio management wise, et cetera, you had to have that done by December 31st. So you can't tax loss sell now and get that on your taxes. That all had to happen last year. So, but yeah, you've got it. If you're going to make your IRA contribution, your Roth IRA contribution, your SEP IRA contributions, those all have to be done, by midnight on filing date. So again, I would not wait till the last minute because a lot of advisors and brokers are going to be very, very busy with everybody trying to do it. So if you want to get it done, I would encourage you to do it sooner than later.
Okay. If folks need help, have questions, is there time for them to reach out to the financial planners at RIA?
Absolutely.
Okay.
Yeah, absolutely.
All right. So folks, go to thoughtfulmoney.com, use the form there to submit raise your hand for them. Okay. So back to recession risk, just real quick.
Wait,
yeah.
one quick one. Roth IRA conversions. That is one of the best right now. We just did a whole segment on this the other day on the radio show, which is that one of the best tariff trades right now is to do a Roth IRA conversion, especially with a sell-off, because there's a lot of you've got a reduced cost basis and a lot of your tax deferred accounts because of the sell-off. So the tax you'll take on that Roth conversion will be less, and then you'll move it to a tax-free status going forward when this market starts to recover. So if you haven't talked to your advisor about Roth conversion, if it's not right for everybody, but if you haven't talked to somebody about Roth IRA conversions, this is a good time to do it.
All right, folks.
Because of where the market is.
I'm glad you flagged that. So folks, if you think that that's something that you should potentially look into, again, you don't have a lot of time for it. So thoughtfulmoney.com, fill out the short form there to be matched with the advisors to talk about that in more detail. Okay, recession risk. So in just the past week alone, think of my discussions with David Hay, Jim Carson, Jan Van Eck, Stephanie Pomboy, they all see a recession as very likely at this point. BlackRock's Larry Fink said that most CEOs are telling him, hey, we're already in a recession. I think the soundbite from that interview was Fink saying the canary is sick here. This guy named Lance Roberts just wrote this really compelling piece called The Consumer is Tapping Out. So anything you want to talk more about this, besides the fact that so many people are getting on this train that maybe it actually might end up at a different station than we're all expecting at this point because of Bob Farrell's rule?
Yeah, I mean, look, I don't think the risk of recession right now is as high as kind of what's been put out there. You take a look at and again, here's the problem. We've got a lot of trailing economic data we're looking at. So some of the impacts from tariffs and things that are happening, that has yet to show up. So,
yeah. So, sorry to interrupt, but let me mention one thing that you can integrate in your answer, which is in my interview with Jan Van Eck, he was looking at the administration's current efforts to curtail fiscal spending, like the fiscal deficit, and contrasted it to the profligate spending of the past number of years. And basically just doing the math and saying, man, if they basically reduce the deficit by $1 trillion-ish, and he shows the math to say that's not crazy. He said that by itself will probably likely trigger a recession, given how dependent the system has become on fiscal spending.
Mm-hmm.
So I just want to include that fiscal part in addition to the other things you're talking about, right?
Right. And again, there's certainly risk, whether it's the economic data is slowing down. We don't have big spending programs in place, and there's certainly a risk of recession here. The economy is slowing down for sure. And this has been our whole premise why yields will ultimately fall. And, this systemic issue we've got going on right now with the bond trade, or sorry, with the bond market is, certainly it's certainly going to exacerbate that risk of recession. If tariffs were implemented at the rate that they were expected to implement, then that was certainly going to exacerbate the recession risk. But there's still, if you take a look at the consumer, they're still, kind of moving along in the right direction. There are certainly some signs that they are starting to run out. We're seeing, and again, that was the whole point of that article I wrote today, is you're seeing rise in delinquency rates, you're seeing rise in default rates, those type of things. Certainly some stress on the board. Does that guarantee a recession? Not necessarily. Does it guarantee slower economic growth? Absolutely. A lot of this will have to translate over. Do we see a big spike in unemployment, right? Ultimately, at the end of the day, this was, remember, but we had 2 quarters of negative growth back in 2023. Everybody was expecting, we're going to definitely have a recession. But we never had the recession because we never had unemployment unravel.
Right.
So
because we had a lot of fiscal spending and other things juicing the system.
No, absolutely right. That's absolutely correct. We don't have that now. So the one thing to watch is, if you want to know for certain if we're going to have a recession, is really watch that unemployment data. Now, we just had an employment report out that was pretty good, but it's lagging. That was February. That was before all the tariffs and stuff that's going on right now. So
everybody was front loading and there was demand to hire. Yeah,
exactly. So just kind of discount that one. But I think over the next couple of months, and again, I really wouldn't even look at this month's because we're right in the middle of it right now. But I think once you start seeing the May report and the June report and the July report, I think we'll have a much better, I think you and I will be having a conversation. It's like, recession risk are really starting to tick up here. Or, we're going to have much slower economic growth, maybe mild, maybe a mild recession for a quarter or two. We'll see. But here's the interesting thing. I just posted this on X this morning, which was, I just went to S&P. I've been watching S&P really closely, not the market, S&P Global, which is the company that produces the S&P 500 index and reports earnings and those type of things. So they update Sam Stovall, who works for S&P Global. He basically updates earnings estimates for the S&P 500 about 3 or 4 times a month. So I regularly go to the website and I'll look to see what his latest estimates are. Well, they just came out yesterday, April the 8th, so day before yesterday. And the really interesting thing is that you would expect from the implementation of tariffs, slower economic growth, that we would see earnings coming down all across the board, right? We would expect to see much lower earnings growth later this year, and then particularly in 2026. If you're going to have a recession, that would be it. But no, we went from 210 in quarter 4. We were looking at about 212 for this. So for second quarter, we were about 212, 215. So that got ratcheted down to 179. But immediately in the following quarter, we're back up to trend. And estimates for 2026 actually went up from 283 to 284.
Are you kidding me?
Yeah. So 2 things from this. One, what analysts are expecting right now is a very short-term impact to earnings due to tariffs. And what they're telling you is that tariffs aren't going to be around for very long. Mm-hmm. That there are going to be this impact from tariffs. Tariffs are going to get removed, and then profitability is going to pick right back up for companies. Now, whether this is right or not is your debate. I'm telling you that earnings estimates are coming down for 2026. No doubt about it. We're just not there yet. But this,
and you were ringing that bell way before this whole Liberation Day thing, right?
Exactly.
So they're basically saying, hey, we're seeing your Liberation Day and barely taking it into account.
Exactly. And so we said, hey, earnings are going to come down. 220 is the long-term linear trend here. So, you got 284 to 220. If you get to recession, you're going to be at 220-ish. So you can look back in 2020, 2022, we were headed there. We had that slowdown in earnings, and you went well below the trend line. You were above it, and, kind of heading back into 2022. So we had all that stimulus. So earnings got back above that trend. But earnings float around that trend line long term. This deviation is going to get resolved at some point. And if we have a recession, they'll certainly do the trick. But again, I just thought it was interesting that analysts are very optimistic about forward earnings. The good news about that is that this price correction is bringing valuations down quickly because the E in the valuation is not coming down, but the P is. So you're now trading about 18 times forward earnings. Historical kind of at median since turn of the century is around 17. So on a valuation basis, based on forward earnings, markets are getting back to kind of quote unquote fair value as long as that E remains where it is. It won't.
Right.
But
Which you think it won't. Yeah. No. So it's a two shoe dropping process, and one shoe is dropping, which is that multiples are coming down.
right.
But then the E will come down and make the multiple high again, which will then have to come back down.
Yeah.
So
And so this,
yeah, go ahead.
yeah, and this chart here is operating profit margin from Scotiabank. They're expecting operating profits at an all-time high next year. So, nobody's concerned right now about tariffs or an economic recession as far as earnings go. Only kind of people running around the media going, it's going to be a recession. But analysts don't expect it.
So analysts don't expect it, but let me ask you this, Lance. So I get why you're not like pounding the table saying there's got to be a recession. But if you expect to have the 2022 kind of year we're going to have here, right, then asset prices still should grind downwards. And at some point, you get that negative wealth effect amongst the affluent households that have really been carrying a disproportionate share of spending. So I'm just curious why that doesn't make you a little bit more like, I think we're going to have a recession.
Well, so first of all, we have to back up. What's a recession? A recession is negative earnings growth. Negative economic growth.
Negative
right?
GDP, yeah.
Right, negative GDP. Well, we're running about 2.3, 2.4 on a real basis. So you've got to reverse. So the reason I'm not pounding the table on a recession is that you've got to reverse that entire 2.3% real growth to get to negative. So there's a pretty big gap in the earnings that we've got to slow the economy down first before you start getting into negative recessionary environment. Now, if we were at 1%, real growth right now, I'd be a lot more pounding the table. But you've got to take a big chunk of activity out of the economy just to get to zero. So again, that's why I'm saying slower economic growth, potential for recession, but there's so many dynamics to this, right? If the Fed steps in, starts slashing rates, we start doing QE programs, the government comes in, does a spending bill or does tax cuts, which is kind of the plan. They want to do tax cuts. We'll see if they actually get that passed or not. There's a lot of things that can happen. So I just want to be careful saying, oh, we're definitely going to have a recession. Then everybody goes in positions for recession. And then it's 2022 all over again, and there's no recession, and everybody's kind of behind the curve. So
Yeah.
this is something we navigate. And then, like the article today is the consumers are getting tapped out. Got to pay attention to that, but it's not time to position for it.
Okay. So get that. I just want to push back on one thing.
Sure.
What's GDP now saying?
Well, GDP now you have to adjust for the gold prices, but I think they're about zero once you adjust for gold imports. I haven't checked over the last few days. Have you
Well,
checked?
actually, you're right. You're right. I'm looking at it right now. It's negative 2.4. Then if you do the gold adjusted, it's like negative 0.3.
Yeah.
Yeah.
So,
But the point there is that's not 2.5. That's not positive 2.5% anymore.
well, no, but we're also still getting data from we don't have the final data, and so that employment report was good. If we have any more
Yeah, but we're close. We're close to the end of
March.
Q1 here.
Yeah.
They're not adding much more into this from here.
Right. Yeah, I know we're getting close. We got a few economic reports still coming in for March that will feed into that. So I mean, again, you got to be careful. They're not precisely accurate. In other words, they could say that GDP is going to be negative 0.3, and then we get a 1.3% growth rate from BEA, which is all that matters.
Okay.
All right, and I do expect by the way, I do expect quarter one to be in the, kind of the 1.3 range on GDP. When the Bureau of Economic Analysis announces it, GDP will be 1 to 1.3, most likely somewhere in there.
Okay, and even if that's true, just to my point, that's now getting closer, right? I mean, so. Anyways, I'm not trying to make the case. Hey, Lance, there's definitely going to be one. I don't know, like you. We're going to look at everything, and of course, unemployment is the key indicator, right? If unemployment doesn't suffer, it's going to be hard to see how a recession could materialize. I'll take the over on the recession on the unemployment rate, but we'll track that on a weekly basis as we usually do. All right, we're getting tight on time. I want to squeeze in a couple of things. So maybe we get the short answers on these things, Lance, and then we can expound on them more in the future if folks want us to. So Chris over at RIA, he is sort of your first point of contact for many of the folks that fill out the form and want to talk to RIA with their questions. And so he's got the pulse on what people who reach out are thinking about, worried about, talking about. So he flagged for me a couple of questions that he's hearing a lot from people, and I just wanted to ask them of you. But let me take your screen off here, Lance.
Yeah, I was trying
Okay.
to find the unshare button. Thank you.
No worries. Okay. Two things. One, with the potential risk of recession does come the fear of job loss, right? And we're already beginning to see a spike in companies laying people off here. So some people are actually already getting laid off. And one of the questions that I guess he's been hearing a lot is, hey, like, are there any things I should be doing if I lose my job, right? And a couple of things that I've thought of, and feel free to add to this list with what you tell people to do. But one is obviously you should create a new household budget and just say, look, if our income's been impaired, we gotta get real clear real fast about how much we can spend going forward. But the question of 401k rollovers, right? Hey, you're leaving a company, you might have a 401k there. Do you want to leave it there? I mean, is that the best place to leave it? And B, do you want to leave it with those guys that just canned you, right? Do you want to put it into something that you control, that you have more options in, that might be a better place for you? So A, what would you say about that? And is there anything else you would add to that list?
So yeah, a couple of things. That's a great point, by the way. So first of all, you leaving your 401k plan at the company that fired you. They don't really control it that much. There's a brokerage firm that has it, so they're not going to go in and mess with it. So just be aware of that. Definitely the first steps. If you think you're going to lose your job, you definitely want to start building an emergency. We talk about an emergency cushion.
Mm-hmm.
6 months worth of your salary should be saved up at all times anyway, just in cash. It shouldn't be invested. Shouldn't be put anything. It should just be in the money market. I don't care if it pays zero. It's there for an emergency, like getting laid off. So definitely start setting aside that money to have that available if you think you're going to lose your job. Second thing is, like Adam just said, it's slash and burn time for the budget. Basically, you get down to raw essentials, rice and beans, and you start selling anything that's not nailed down if necessary to make sure that you can continue to pay bills while you're looking for a new job. So now let's get the 401k plan. There's a couple of things to consider with rolling over a 401k plan. Most people want to roll that into an IRA. They go, well, I'm leaving this company. I'm going to roll it into an IRA, then I'll just invest it. And that's okay. There's nothing wrong with that. We manage IRAs, rollover IRAs all the time. But if you're fairly young in life and not closer to retirement, if you're in your 30s or your 40s, and you're going to get reemployed at some point, either roll it into a rollover IRA and just leave it alone, depending on how long you think you're going to be unemployed, or if you think you can get reemployed pretty quickly within 3 or 6 months, just leave it where it is. And then you want to roll that into your new 401k plan at your new company. And the reason for that is really twofold. One, most individuals do a terrible job of managing their own IRAs. So they put them in an IRA and they do a terrible job managing it and lose a bunch of money. The second thing is when you roll that into your 401k plan at work, you're also getting the match from the company. So for most people, the majority of their gains come from their contributions to that portfolio and the matches that come from the employer. So as the portfolio grows, you say, well, Lance, that's the same thing. Even if I just roll that into an IRA over here and then just start from scratch, it's true, but the percentage gain is larger on the larger balance than on the zero. So as the market's working for you, you want more money working for you in that plan as you're contributing to it and as you're growing it, those type of things. Again, nothing wrong with rolling it to an IRA. That's completely fine. as long as you've got somebody good that can manage it for you so that you don't destroy that value. The biggest problem that most people try to manage their IRA rollovers is they destroy the value in it. And that's their retirement money because they get too aggressive. They make stupid mistakes. They try to buy real estate in their IRA, which is a terrible idea. They do a lot of these really bad things for their retirement money. This is money meant for your retirement, which should be the most conservative asset you have, right? Your 401k plan should be the most conservatively allocated asset you have because that's got to be there when you retire. If you want to speculate, do that in a taxable account where if you lose money, at least you can write it off on your taxes. But, so if you need help with trying to figure it out, email me. I'll kind of look at your situation. I'll say, this is your best alternative. Do this or do that. Happy.
Okay. Let me ask this, and we're speaking in great generalities here, but what would you prefer? Leaving it in your old 401k where you're not getting matched anymore, but it's being managed the way it was before, or putting it in a rollover IRA but having a professional, if you don't feel up to the task, managing it for you, because in your own IRA, you have a lot more options, correct? I mean, in the 401k, you generally just get, here's one of the five funds, right?
No, if my only choice is to leave it in my former employer or roll it to an IRA, if that's my only choice, I'm not working anymore. Right. I'm not going to go to work anymore. Then yes, absolutely 100% roll it over into an IRA and go get yourself a really good advisor to manage your account. But again, if you're only going to be short-term unemployed and go into a new company and it's a smaller amount, say it's 30,000 or 50,000, it's a smaller amount of money, you're better off rolling that into your new 401k plan versus an IRA.
If you're going to get the match and everything. Yeah, no, I get that. Okay.
So again, it's very specific to each individual, and that's what I'm saying. If you're in that situation, you need help, send me an email. If you go to my website, realinvestmentadvice.com, we've got an ask a question button. It comes right to my desk. So if you're in this situation, need some help, I'm more than happy to give you some guidance.
All right, well, you're very generous on that. Last thing on layoffs, just for folks that haven't gotten it yet, if you work for a paycheck, if you work for an employer, theoretically, you're vulnerable to that employer deciding at some point that they can't employ you anymore and getting laid off. So there are steps that you can take in advance of that potentially happening that can hopefully reduce your chances of getting laid off, or at least reduce your vulnerability in case you get laid off. And then obviously, if you do get laid off, there's some very important steps you want to take right away. I've written all those up in my new guide, or it's a guide I'd written years ago, but I've recently updated it, called the Layoff Survival Guide. You can get that at thoughtfulmoney.com/layoffs, totally free. All right, here is another question, and this is more for people who are close to retirement, right? So on the other end of the spectrum from the people you were just talking about, Lance. Big question is, do I have enough money to retire? Thinking about retiring, here's what I got. Do I have enough? So I know this is a very classic question for your team. I'll let you run on it. The one thing that Chris mentioned that I just think is important to really note for folks is, if you are indeed planning on retiring, you should get things lined up with whatever advisory firm you're going to work with, like a year in advance. Like, make sure that they are aware of your plans. You've had this discussion about, do you have enough? You've come up with your plan on how many withdrawals on average you want to make a year, how this stuff's going to be allocated and whatnot. And there's just a lot of things you got to do to get everything set up to have a nice glide path to your retirement. Don't just retire and then call up an advisor and say, hey, I retired, now what, right?
Actually, I would argue with that. I would say that if you're serious about wanting to retire, you should get with an advisor probably 15 years ahead of time. So that you build a financial plan, you build a trajectory, how much you need to save, what the goals are, you manage your risk, and then all that leads into your final stage. You're absolutely right. The problem with most people coming, and we get a lot of these, right? Hey, I've just retired, I'm about to retire. They come to us and then it's like, okay, now you got to sort all this mess out. And there was so much stuff that could have been done 5 years ago or 10 years ago, insurance planning, et cetera, that would put them in such a much better position. They missed all those opportunities. And now you're just in this, you've got this chunk of money saved up, but you missed all these opportunities to put yourself in a much better position had you been planning early for retirement. So, so just from a planning perspective, this is the one thing that, and a lot of advisors get a bad rap, and they deserve it. But a lot of people look at advisors like me and they say, oh, there's just portfolio management. No, we're like doctors, and, you want to get with your doctor, not when you're having the heart attack, but, when you're healthy, to make sure you don't have the heart attack, right? So, that's the real value of a good advisor, is that, building these vulnerability cushions, planning for insurance, planning for healthcare expenses, planning for long-term care. You can't do those at the last minute. Those have to be planned for years, decades in advance, because it takes time to fund those and make sure you've got that money in place when you're going to need it.
Well, very well said. You know, I actually love this part, both helping people get connected with the planning that's going to really serve them down the
Yep.
road. But I also just love doing it myself. And in fact, the firm that I work with, there's a financial planning software that they use, and so you can put all these different sensitivity analyses in there. And the key thing that you and I have talked about is if you tell them what your goals are, and then they look at your assets and the path, oftentimes they can say, hey, we can actually help you hit your goals on the timeline you're looking to hit them on, but we don't need to take full market risk to do that, right? And that's the best. That's the best thing ever, right? Oh, I can still hit the goal, but I can sleep even better at night because I'm taking less risk. Fantastic,
Yeah,
right?
that sounds great in theory, and we have that same software that we give to clients, and they can twiddle around with it, play with it, make all these projections, and it's great. And yeah, I mean, the vast majority of the people we work with that we do that for is like, oh yeah, you only need 4% to get to your goal. So if you just get 4% a year, you're more than fine. You're going to be fantastic. But then it's like, but the market's up 10. Why aren't we up 10? Right? It's always the greed factor that comes into this. But that's the value, though, really, of that financial planning and doing that analysis. That we do that, we run those updates every year, we adjust those. There's a lot of problems with that software, so you got to be really careful. A lot of the software, I don't know which one you're using, but most of those software programs, they use static rate of return, so 6% a year, 10% a year, whatever it is. We use variable rates. We front load bear markets. We back load bear markets for tests. We put in all these variable issues that says, look, if this happens during your lifespan of savings, this is going to be the impact to your portfolio. So as long as we keep in that 95 to 90%, 99% success range, even with those variable events all plugged into the system, we adjust for inflation rates. We adjust for, tariffs, whether or not they're going to be on or not. We make all those calculations and then adjust those forward expectations to ensure that even with those variabilities, that you stay within a 95 to 99% success range for retirement. You're in pretty good shape.
Yeah, and that's what I love. And I love seeing like all the Monte Carlo stuff of like,
Yeah.
well, what if we have a recession next year? And it's again, when it comes in at like 98, 99%,
Yeah.
you're like, okay, good. I think I'm okay. And
Yeah.
I am definitely one
Just
of
be
those clients where they were like, hey, you're asking us so many questions, Adam. Here's the software. You play with it you want. So I just
yeah.
geek out and, imagine all sorts
No,
of terrible things.
it's the greatest thing ever. Like I said, just be careful if and I'm not talking to you, Adam, I'm talking to people
No, I
listening.
know.
If if you get a plan from a financial advisor and it just shows you 6% a year return, it's not worth the money it's
Right.
written on. Most important thing about financial plans. This is the most important thing about financial plan. You go to an advisor, they give you a financial plan, says, hey, based on this projection, you're going to be fine. You're going to 99% success rate. That plan is good for 12 months. You have to review that plan every single year and update that plan every single year. And if you're not doing that, it's not worth the paper it's written on, because your life changes, expectations change, incomes change, markets change. If you're not making those changes to your financial plan and adapting for the variabilities in the markets in your life, the plan's not any good. It's
Right.
just a
It's like
worthless piece of
it's
paper.
like getting a physical and assuming that physical results are good for the next 20 years. It's like, no, you get to
Exactly.
go in every year. Yeah.
Yeah.
Yeah. All right. Well, look, we're
Oh
getting
wait, we
pressed
never
on.
answered the question. We never answered the one question you asked me, which was how much money you need for retirement.
Yeah. Okay. Sorry. Go ahead.
Yeah. So there's no answer to that, because we have clients that have 10 million in assets and they cannot retire because they spend $1 million a year. I have clients that have $500,000. They're golden for retirement because their lifestyle fits within the retirement. So the one thing I want you to dismiss is when you see all these analysis in the markets and say, oh, if you have 25 times your salary, you'll be able to retire. It's completely erroneous. It has nothing to do with anything that happens in real life. It is about how much you spend, what your income is, and what your income and adjusted for inflation and Social Security and those type of things are going to be in retirement. And so if you're, for somebody that spends 20 grand a month, their retirement number is very different than a guy that spends 3 grand a month. So this is part of that financial planning process Adam was just talking about. There is no set number for retirement. There is no golden ratio for retirement. It all depends on what your lifestyle looks like. And so you want to make sure that your financial plan, and this is the one thing, by the way, doing your financial plan, going back to that, there's 3 people you don't lie to in this world: your doctor, your lawyer, and your priest. The other guy is the advisor, because
you got to add your spouse in there too, or we're going to get a ton of hate comments.
Sorry?
You got to add your spouse to that list too, or we're going to get a ton of hate comments.
Look, hey, Adam, if your wife comes to you and says, "Do I look good in these pants?" What are you going to say?
All right, fair point. Fair point.
Okay, everybody lies to their spouse, no doubt. Anyway, but you don't lie to your advisor. I tell you, the one big problem I have with prospects that I work with or with clients that we've worked with is that we sit down with them and they go, "Well, how much you spend every month?" Like, "Oh, we spend $2,500 a month, whatever it is." Mm-hmm. And they just, and the reality is they're spending like 10 grand a month. So you've got to be very honest with your advisor when you're doing these financial plans. If you're spending a bunch of crazy money, it's okay. They don't care. They're not going to judge you on how much you spend every month. But a lot of times we want to hide how much debt we have or how much we spend or how much money we waste, whatever it is, because we're just embarrassed to say that. But don't be, because if you put fraudulent data into your financial plan, you're going to get a fraudulent output. So, the financial plans is only as good as what you put into it. So, be very honest about it, and you'll get a much better outcome. But there is no set number for retirement. It all depends on what you spend.
Okay. And my only thing I'd add to that is, so you got to do the math, right? Like you literally have to get your own personal math down, and then, based on that honest data, figure out what's realistic for you. And again, you can do it all yourself. And if you're talented at that, great. I would say most people aren't, for a whole bunch of reasons. Some skill level, but a lot of it is just emotion. And this is where you want to just get a great coach, right? Somebody who can walk you through the whole process, someone who's done a zillion of these, right? All right, so that kind of brings me to my rant, and then we'll wrap things up, Lance. And we will go through your trades. I know you got a lot that you did.
Can I say can I hit one thing real quick before we do this? I got probably 30 emails this week from people talking about some articles that were put about it, because after that big monster rally that we had on Wednesday, all these emails, it's like, this was one of the 10 best days in the market. You can't miss the 10 best days. And I just wanted to show you something real quick, because you hear this a lot about missing the 10 best days in the markets, and it really impairs your return. If you miss those 10 best days, it really impairs your returns over time. And that is a true statement, by the way. If you do miss 10 best days, you do impair your returns. But this is the daily price change in the markets going back in history. What you'll notice is that the 10 best days occur at the same time the 10 worst days are occurring. So what is more important, if you want to really master your rates of return over time, you want to work on missing the 10 worst days rather than trying to grab the 10 best days. Because if just by missing the 10 worst days, you will 5x your returns over history. Because of the problem with capital destruction and the recovery time it takes to get capital back. But all this, you got to stay invested, you got to buy and hold because you can't miss the 10 best days. Yeah, you may get the 10 best days, but you're also capturing the 10 worst days because they're all happening at the same time.
Okay, let me make sure I understand what you're saying and ask the question this way. I mean, hard to capture the best days, but avoid the worst days because those are volatile periods like this week. You don't know any given week what's going to happen the next day. And this week's had massive swings in both directions.
Yep.
So are you saying 5x if you just get the best days and miss the bad days? Or are you saying 5x if you just are out of the market during the volatile period, so you miss both?
Well, so if you could, right, and nobody can, right? This is the whole point of it. And this is the buy and hold thesis that people want to throw out there. It's like, oh, this is why you have to buy and hold. This is a chart. The black line's the S&P. So just buy and hold the S&P, that's your return. if you just missed the best day, if you only got the best days of the markets, right? And that's where they say, oh, your return's going to be so much better. So the blue line is missing out on the 10 best days. So if I miss the 10 best days, yes, it's definitely going to impact your returns. But the red line is just missing the 10 worst days. And so the point of this is that what is important about managing a portfolio is missing those periods of capital destruction, because those impair your forward returns more than missing the 10 best days. Because if I just kept, because the markets rise more often than they go down over time, right? So
Yep.
if I can just avoid periods of major volatility, which is where you get all your bad days clustered. So if I can just avoid the bear markets, the 2022 markets, the pandemic, and then you don't have to avoid 100% of it. That's not the goal. But markets are down 10, we're down 3. We're avoiding a big chunk of those big downside losses, which allows us to get back to even and start growing money sooner than people are just trading the market and they've got to get 10% back just to get back to even, right? So the point is just disregard a lot of this stuff that runs in the media about, oh, well, you just can't, you can't miss the 10 best days, and you can't navigate markets, you can't manage risk, you just got to buy and hold. That's really not true. It just takes a little bit of work, and you can improve your returns over time by doing that.
All right, good point. Good point. All right. So yeah, flip the script. I'm not trying to catch the 10 best days. I'm just trying to miss the 10 worst. Okay. Quick rant, and then we'll get to your trades, and we'll wrap it up.
Sure.
So I'll be quick here, but I'm hearing stories of some people that got caught unawares of what's happened over the past 10 days, just like the major hedge funds, the Citadels and stuff of the world too, right?
Yeah.
And so I want to let people know, like, if you're one of those people who just were overextended, have taken losses you don't want to take, and you're feeling stress about that, pain, maybe even anguish, I just want to let you know two things. That I get it. I've been there. We all, as investors, have learned from the school of hard knocks. And the key thing to realize is that you can learn from this, and you can recover from this. Obviously, if you're younger, you'll have plenty of time to recover. But even if you're older, don't make snap decisions in a panic right now. And the gyrations of this week, Lance, have made me reflect back on both the dot-com crash, but also 9/11. And you remember how the markets were closed, right?
Yep.
So I was a young graduate from business school then. My wife and I were newly married and pregnant early in our marriage. And I think our daughter was born in October of 2001, right? So less than a month after 9/11. So when 9/11 happened, a couple of things have been going on. One, the dot-com bust was on, and I had been part of a startup, and it had actually gotten acquired. And for a brief moment in history, I had a paper net worth that was way higher than I ever imagined it would be coming right out of business school, where I had nothing but debt, right?
Yeah.
And then since the acquisition towards 9/11, the markets just suffered and suffered and suffered and suffered. And I had invested into a lot of this stuff, so I couldn't sell it. So I was just watching this windfall evaporate in front of my eyes. And so by the time 9/11 came around, I think my total net worth, what was left of this investment plus my student loans, was like, it was 4 digits. I mean, it was probably like 9 grand, right? But it was all I had in the world. And we were now about to have a baby. And my wife and I had gotten laid off in the months leading up to 9/11 because of the dot-com bust. So it was just nothing but stress. We were living above a small garage in Silicon Valley. So, it was our little starter, pad. We were just starting our lives together. So literally this number on my spreadsheet was like all I had in the world in terms of financial wealth. And then 9/11 happened, and we all waited with bated breath to see what was going to happen when the markets reopened. And I remember the morning the markets reopened. I got up, I waited for the markets to open. They opened I can't remember how much lower, but a huge amount lower. And of course, my equity in this tech company just got zorched.
Yeah.
And I remember looking at the screen, then walking downstairs to the bathroom while my wife is still asleep and just throwing up, my intestines. I mean, just literally, it just felt like the world was over. And so, folks, if you're sitting on losses, like I said, I've been there. I know what it feels like to feel like you've just suffered a loss that you can't possibly come back from. The answer is there will be ways to make repair. There will be chances the market gives you to start rebuilding again. And oftentimes, a lot of these companies that got killed, during the dot-com bust, if you held them long enough, they did come back. Some of them took a long time. But my point here is just don't do anything drastic, right? Take a beat. Uh, and this is where I will say, I'm going to borrow another thing that Jim Carson said about the importance of a good expert at times like this in your life. He's like, hey, look, there's a lot you can do on your own to stay healthy, but like when you have a major health issue, you go to a doctor, right? You don't perform your own surgery on yourself, right? That's when you really want a dedicated expert. Same thing legally. Sure, you can use, online legal forms for routine things, but you're getting named in a lawsuit. You want a really good law firm to defend you, right? If you find yourself in trouble financially, get a really good expert to advise you on it, to help you out of it. So if you're sitting here on some painful losses, highly recommend that you seek the counsel of a really good qualified financial expert to help you come up with a plan of what to do next. Don't, like I said, just sell everything willy-nilly or say, oh my God, I got to win a lottery ticket to dig out of this hole and I'm going to buy highly speculative, asset X because it's the only thing that can drag me out of this. Just take a beat, take a breath, go talk to a professional and listen to their counsel and see what your true option set is. So that's my rant, Lance. What would you add to it?
No, I think that's right. I mean, it's interesting because, this is when, and we've talked about this before, but this is when we make the worst mistakes as investors. We get too greedy on the upside and then we panic sell on the downside. And I tell you, it's kind of an interesting week. Um, you know, I don't like losing money. I am super competitive by nature. It comes from my years in, competitive fighting, et cetera. Just, I have a very competitive nature. So losing money at all is weighs on me very heavily. And it makes me just, and again, it's like a couple of times this week, I wanted to literally just throw up because this market was what this market was doing. And yeah, our portfolios are down 3, the market's down 10. It's fine, but I don't even like losing the 3 because it's just not, it's my nature to just not do that. But this is where the challenge is. And so like in my personal trading account, starting last Friday, I was buying triple Qs. So I bought triple Qs on Friday. I bought them Monday. The more the market went down, I kept buying them. And because I knew this market was going to bounce, I didn't know when. I said, but this market's so stretched, I'm going to bounce out of this. And so it, bounced heavily on Wednesday. I sold everything. I was like, I'm out. And so, you know, but, but that's, kind of where, the hard, I wrote about this several times in articles over last week, is that when it comes time to buy, when things, and that's really my personal challenge, is that when things are really bad, I don't want to buy, right? That's human nature. It's like, oh my gosh, this is going to keep going down. I can't afford to do this. I have to force myself to buy stuff. And that's what we did, on Wednesday morning. We were in the markets buying stuff, even though it felt absolutely terrible, but we were starting to see some processes. And again, as the market rallied, we were able to take that money off the table and make a trade out of that. But when you don't want to buy, that's typically when you need to start buying. And when you want to buy everything, that's when you need to really think about selling. And so that's when, Adam, you and I have talked about numerous times over the, really just even earlier this year, we were taking profits out of NVIDIA, taking profits out of, tech stocks, taking profits over here. And the markets are doing great, but that's why we're always constantly rebalancing. We're taking profits, reducing risk, increasing risk based on what the market is, because that helps us just navigate through the markets. And that way we don't get trapped into a position where all of a sudden everything is down, 15% in 3 days, and you're trying to figure out what to do, especially when you have, positions in the market like Apple or Microsoft that can move 10% in a day. We saw Tesla down 15% in a day. for most people, they're at work, they come home and it's like, oh man, my Tesla position now 15% a day. What the hell just happened? That's where we start making all these mistakes. And, and so part of this is learning to control emotions. But this is why we write so many articles about emotional biases, investment mistakes, investment trading mistakes, and stupid behaviors that we have. It's not really, I write these articles and we publish them. It's not for you. It's for me, right? These are all my reminders about what not to do in the markets and public. Like I published Gerald Loeb's 12 investment rules a couple of weeks ago. That wasn't for you. That was for me to remind me that when I'm managing money, I've got to always go back to our discipline, go back to our focus, go back to what, and again, this is the market we're in right now. Markets are trying to rally a bit here. Why are we adding a short position? Because we've got a weekly sell signal. Historically, that weekly sell signal suggests that you're going to have a lot more market volatility and lower prices, at least near term. It may not last long, and then we'll take it off, but we have that sell signal in place, so we need to honor it until it reverses. So again, that's just part of that discipline. We talked about, sitting down previously about writing your investment policy statement, doing those things. That's the important part to do here, so you don't make mistakes that make a mistake even worse. And that's the biggest thing that happens to investors is they compound mistakes over and over and over again.
Right.
And it gets them in a hole they can't get out of.
Right. And it is tended like a vicious cycle. Something bad happens, you make an emotional reaction-based decision to that. That's a bad decision. You get more panicked, you then make an even worse decision, right?
Yep.
So, like I said, folks, just take a beat, literally just breathe,
Yep.
and then have a conversation with an expert. Okay.
Yeah, I think I actually said this on your show last week. We're having a lot of volatility. I said best thing to do is just turn everything off and go play golf. And I got a bunch of angry emails like, I have a job, I can't go play golf. My point was you just step away from the markets, and sometimes doing nothing is the best thing. And so, when you feel emotionally stressed, turn everything off and go, like Adam said, go do something else for a while, get your mind off of it, clear your head a bit, and then come back with a fresh view and take a look at where you are.
Yeah. All right. Well, look, we got to get to trades, then we got to wrap up here given time. So you said you did a ton of trades this week. Try to summarize as best you can.
Yeah, I really can't go through all. I mean, I could go one by one, but we did probably about 20 trades in each one of the three models. So, but we did reduce, basically we just reduced a lot of equity. And we talked about this last week, that when we get the sell signal, I actually wrote an article on this last week, talking about the sell signal and the actions to take. And I said we'd be reducing our portfolio by 1/4 to 1/2%. That article is posted on the website from last week. And that's what we did. We just went in and we basically just chopped about 15 stocks that we owned by 1/4 to 1/2% each in the portfolio.
So did every stock get the same haircut, or were you selective by sectors?
We were selective. Okay. Like for instance, AbbVie is a good example. We've held AbbVie for years. We love this company. We're going to own it for years. But right now it's very exposed to what's happening with these Chinese tariffs, and they make Botox and other stuff. So that's a company we're never going to sell. But it was 5% of our portfolio, so we cut that one to 2.5. So we took a big chunk out of that one because of its exposure. Eli Lilly was about 3.5. We took it to 1.5, or no, 2%. So a big reduction there. But like Palantir, Microsoft, Apple, those companies, we reduced by 1%, or which would, like if it's a 4% position, 1/4 that's 1, right? So we reduced it by 1%. So some positions got a bigger haircut than others based on tariff exposure, risk, those type of things. And we just kind of rebalanced the portfolio to raise that cash level and just kind of get positions more tolerant for market volatility.
Okay. So obviously that was stocks, and then bonds, you moved to nearer duration.
Right. So, we had a long position in EDV, which in the simple advisor models, we reduced that by half. And we shifted all of that into 1 to 3 year treasuries. So we just reduced the duration until the bond market settles down. Then I'll take that money and put it back into EDV. But again, we've held EDV for a long time, and we have we were positive on that position. So again, we reduced it, but we've been collecting interest income now for 2 years, 3 years on that position. So again, so we've collected a lot of money. The position was down in price, right? But total return was about even. But so we reduced that for now, and then again, once this bond market crisis passes and yields hopefully, will be up around 4.5, that gives us a really great opportunity to, build in that position and probably increase it in size, particularly if we are heading into a recession.
Okay. All right. Well, look, we talked about how this might be an interesting year. Things have certainly gotten interesting. Maybe we might want to cross our fingers and hope for things to be a little more boring in the next couple of weeks versus it's been here. But anyways, thanks for helping make sense of it all for us, Lance, and again, for being so transparent about the specific trading decisions that you guys are making at RIA and the reasons for why you're making those decisions. Super duper helpful for people in general, but particularly during times like this of high uncertainty and
Right.
heightened emotion.
And again, yeah, and just real quick, I mean, all of this could change by the time we meet next week, right? Next week, I may get on the show and say, hey, we're buying bonds and we took off our short and we're increasing stock price, increasing our stock allocations because the Fed came out and announced QE, right? Whatever, there's going to be stuff that happens in this market that's going to require a change. And so again, just every week, don't be surprised if, something happens. My point is be careful taking what I'm telling you now as that's the way it's going to be for weeks or months.
Yeah.
It could very well change next week.
Very good point, which one, folks, is why it's so important to keep tuning in every week, obviously, to get updated or to watch Lance on his morning show every day if you want to get the real-time feed. And also, Lance, I do want to thank you again. We got great feedback from your willingness to come on, I think it was last Friday? And we did a special report. So the fact that we've got the ability to do that, if there are truly late-breaking or truly big breaking developments to get in front of folks immediately, we'll do more of that, folks, as long as you want us to. I'm presuming you do, but obviously let us know in the comments if you've got strong opinions one way or the other. But again, thanks so much for doing that. Super duper helpful.
Yeah. We'll do it again next event.
All right. And again, let's maybe hope it'll be a little while before the next event, but with this market, you never do know. And it's funny, I did, I recorded my biweekly session with Stephanie Plumboy at 8 in the morning on Wednesday. And then I was interviewed by another platform 2 hours later. And in between the two, the market had its 9+% jump in the S&P. So it was like literally two completely different interviews, even though they were separated by an hour.
Exactly.
So what a crazy week. Okay, well, look, so folks, if you are as full of gratitude as I am for Lance for everything he's doing for us and will do in the future, please show that gratitude by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. We've talked a lot this time about all the reasons, some very time urgent, potentially around tax day and or if you're taking some losses, what to do about it. But we talked about lots of reasons why you may want to talk to a good professional financial advisor. So if those are resonating with you and you want to take action on that, if you don't already have a good advisor that you're working with, consider talking to one of the firms that Thoughtful Money endorses, perhaps even Lance and his team there at REA, to set up one of those free consultations. Just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form, and the firms will be in touch with you immediately. And a reminder of memberships. I'll spend more time on it next time. But membership is a way to get more out of this YouTube channel than just what you get on the free version. This is totally new. We're trying this out. If you want to join, it's only $5 a month. Just click the membership link right below this video. It's right next to the subscribe button. But a reminder, if you are a current premium subscriber to our newsletter, our Substack, you don't have to sign up for the membership because you're going to get that additional content through your premium Substack subscription. And that is the gold standard. That is the Cadillac version. So if you just want to get everything good that Thoughtful Money offers on the premium side, just go to thoughtfulmoney.com/newsletter and sign up for the premium Substack. Last, I mentioned a couple of free resources here, the layoff guide, the gold guide. If you don't remember the URLs on how to get there, don't worry. I've made them the pinned comment to this video, so you'll find them right at the top of the comment section. Again, those guides are totally free. We're just trying to help people out with them. All right, Lance, thanks for yet another great week. As usual, I'll give you the last word.
Buckle up. this has been a roller coaster, and I don't think we're done with it yet. So, if you like Coney Island, welcome to the stock market.
All right. Well, like I said, I'm going to hope for some more boredom, but yeah, I'm probably going to be on the losing end of that trade. Again, Lance, thanks so much.
Trust me, I'm all with you. I would love a week of just calm.
All right. Well, when we hop off here, I'm going to go light a candle to the shrine of calm and quiescent markets. But in the interim, Lance, whatever happens, we'll have you making sense for us here next week. So thanks so much for that. Thanks, buddy, and everybody else. Thanks so much for watching.